I'm happy to start this web seminar. It is a great pleasure having here today with us Enrico Perotti and Arvind Krishnamurthy. The topic is extremely important, but let me introduce first the speaker of this event. So this event is thanks to Enrico that wrote a fantastic piece regarding the market maker of last resort and what is the role and when the market maker of last resort should intervene or not. But Enrico Perotti is professor of international finance at the University of Amsterdam and had been, I think, fascinated about this topic because he's a member of the Advisory Scientific Committee of the European Systemic Risk Board, where with me and several other people, we are debating a lot about this topic. And I'm also very pleased having here today as a discussant, Arvind Krishnamurthy, that is professor of finance at Stanford. He is doing research on several topics, but clearly is really studying a lot liquidity crisis and recently also on the importance of US Treasury bonds and the dollar in the international monetary system. So it is the perfect discussant about this topic. I want to remind to all of you that the policy letter that Enrico wrote is now a SAFE policy letter. You can find it online in the SAFE webpage, but I'm not going to spend more time, and I'm giving the floor to Enrico. The only thing that I want to stress is that if you have questions, you can write them in the chat. And, after the presentation of Enrico and the 10 minutes of discussion by Arvind, we will go straight to all your questions and we'll try to make this meeting as much as possible an interactive meeting. So, Enrico, thank you very much.
Thank you very much, Loriana. Thanks, Arvind, for being here. This research was really started 12 years ago at a famous presentation by Arvind at NBER on the notion of discovery of something that was not fully appreciated in finance until then, a safety premium, which would come to dominate a lot of the discussion about safe asset and monetary policy and more generally, really central bank policy. So this inspired a piece that is really a narrative, is related to research I've done, theoretical observation I've done, discussion I've had, and also responds, I think, to a need that I perceive in central banking to think about a core lender of last resort mandate. I will not talk about everything central bank has to do. I'm not competent on that. But on the question of the lender of last resort, it's clearly that a central bank is a monopolist of public money. He has a unique position and unique public responsibility. And there are many lender of last resort tasks suggested besides the core, which is ultimately price and financial stability. And there is a lot of pressure on central banks nowadays to volunteer to support more tasks, going from whether climate growth or potentially a market maker last resort contain private right. But of course, lender last resort comes at a cost. You intervene, you bail out some liquidity in liquid terms, you encourage risk-taking to some degree, there's less future stability. The potential effect on price stability, is there a natural benchmark for the LOR? So the case I want to put forward is that a central bank should commit ex-ante exclusively to a safe call. And the safe call is easily defined, safe asset as essentially nominally safe default-free debt. The claim I'll put forward, and I'll discuss what we know or we have intuition for, is that liquidity need, commitment to cover liquidity need outside the core is not necessarily and is counterproductive. It doesn't mean that of exposed, the central bank won't do things that he say it may not do. the key question is to be extremely clear on having a benchmark from which one would only deviate on compelling reason. The key argument, a liquidity need outside the core can be solved by various forms of repricing, while safety need cannot. So safety need are, in that sense, primary. That's going to be the key message. So creating a clear mandate on safe core define a safe border that has various benefits. It maximizes constructive ambiguity in terms of intervening in private risk creation. It means much less ambiguity for savers that are seeking safe store of value, and it minimizes accordingly any grants and potentially socialized loss. Right, so what are the key drivers? This is the key line. There are two components of money demand. The first is the mean of exchange, and that's what I choose to call liquidity demand, and store of value, which is what I choose to call safety demand, although the terms are out there. These two motives are not well recognized because they're literally fused in diamond debris. Where literally, if you don't get liquidity, you die. So that's an extreme case, and obviously we have a need in reality to separate the two because they are distinct. So what I put forward here, and as part of my research last year, is that a safe store of value is a more primary need, or in any case, a more medium-term need. It's extremely risk intolerant by design, and so it needs to be backed because it is, in a sense, more fundamental, and other things are supported by it. Liquidity demand, as recognized by Gorton and others, can be satisfied by low-risk assets. So even though safe assets are liquid, it doesn't mean that you need perfect safety. And here is all about the safe core. And the argument that is important is that if indeed these two types of demands, which are correlated and overlapping, also for all of us, can be separated, then you can establish balance by pricing without controlling escalation. Now, why do I think there is such a strong difference? I want to show you this graph. They really struck me. When the money market fund reform in 2016 was introduced, money market funds that were prime, so not holding just government debt, were no longer allowed to promise safe principle. So you had to rely on net asset value. And within, very short period of time, the market changed radically with essentially more than essentially 80% moving to the type of fund that guarantees safe principle. Now, it's important to realize that the difference between the two is not large. I mean, money market funds subject to net asset value are extremely high liquidity, and the price risk is pretty small. On the other hand, absolute nominal safety is what people want. Let me leave it as an impression. Obviously, I'm not putting forward empirical evidence here. And let me talk about the characteristic as I see it. Demand for safety is large and inelastic. It's actually very rigid share of wealth rather than a share of transaction. And as Arvind has proven, there is a distinct safety premium on top of liquidity premium. Now, this graph, many of you may know, is from Gorton's metrics work, and they show a striking stability. I don't mean to say literally a constant, but it's a great stability of the fraction of safe asset on US portfolio wealth. And it is so stable in time of high interest rate, low interest rate, it is somewhat structural. I don't believe it's exactly constant because, but I think it is something there that is really different from something that responds to market conditions. So what are the differences? What are the key differences? We demand safe assets as a safe store of value. This is a steady type of demand. We have medium-term horizon. That's why a long-term public debt is a safe asset, because it is attuned to a specific horizon. This demand is quite inelastic to rates, and it is very risk intolerant. It's very prone because essentially it takes literally the notion that you don't want to worry about the value this thing is supposed to be worth that. Liquidity demand has essentially a strong immediate component, fluctuating, of course. It is more price elastic. A lot of it is by firms. As long as there is reliable access to funds, you don't need perfect safety, as also Gorton has shown. So this type of demand is more driven by transactional motives or contingent needs. Ultimately, of course, there is a blend of the two, but there is useful to make that distinction of the two polar dimensions. And we can see that actually, if you look at the share of safe assets in the US, as a share of GDP, which would be the natural indicator, indeed, demand for liquidity were driven just by transaction. Well, safe asset, we have a lot more safe asset than what we used to have as share of GDP, even though transaction efficiency, payment efficiency is much faster. What is stable is the share of private wealth that we hold in safe assets. Now, so if I try to put everything together in the table, what I think is very different is they're both very large. They have different indices somehow. They have different price elasticity. There is some chance, people will move towards something that has a bit of risk for a bit of yield, while safety seekers will not entertain risk gladly. And that's the essential point. In mind. The horizon is also different. One is immediate upon contingency. It's important to have immediate access. Safety is more of a medium-term issue. There is a simple psychological story about why safety is primary. I'm not going to spend time on this. There is Maslow's theory of the hierarchy of human needs that say you need safety before you can start thinking about the economy or thinking about what is meaningful in life. And I'll leave it at that. I just want to say that inside the primary principle that explains this different sensitivity is essentially whether something is just reassuring long-term primary need as opposed to an ongoing economic need. It's not simple, of course, to separate the two. It's necessary because even though there is a lot of overlap, most safe assets are liquid, but many liquid claims are not safe, and this is something that investors should know. They should not be treated as such, and they shouldn't be portrayed as safe. Also, safety is not immediacy, and this is, again, some concept is important. Most deposits are rolled over all the time. So there is a notion that, we need to keep money for liquidity in the bank, but we also keep money for storage. Right. So, in my very graphic way of presenting things, I want to suggest that we have a financial system with a complex architecture, but at the base of it, there is a stable demand for safety that, as long as it's satisfied, it allowed essentially maturity transformation to operate, and liquidity demand and liquidity supply to take place. And, that's the credit dimension, and then ultimately you have the capital market supported by credit. And as I'm essentially here, the notion of the characteristic of the safe or the safety demand is what allows to carry essentially the promise of liquidity by intermediary. Now, if you touch the lower part, I'm sorry about this, but I still found it amusing. You can shake up one house or card at the top and not too much happen, but if you touch the foundation, that's really a bad idea. Now, in the point about the primary versus the sort of extremely important but somewhat less primary notion, this is the point I already made. There is ultimately maturity transformation is built on a stability of people that trust that you can leave the money there, and they leave it there most of the time. And then on the basis of that, you can afford to fund less liquid assets. Now, as I said, the reason we have lost a bit the awareness of that is that it's confusing. I mean, first of all, most safe assets are liquid and not vice versa. But there is a difference that now we understand, largely also thanks to the work of Arvind and Net. Liquid claims carry a convenience yield, and there is an additional safety premium carried by nominally safe debt. And we have lost in Diamond Daybreak's masterpiece. The two things are conflagrated, but ultimately, I think it's essential that we see them different. So let's think about what the central bank's role is in all of this. So what is really important is to understand how this demand component of demand for money contribute risk. So safety demand is extremely risk intolerant. So once you have people that think something is safe, be told that it is not safe, they'll run unconditionally. They do not want to trade price and return, risk and return. And that is exactly what is very dangerous, because this is traditionally the part that is stable and you can count to build further on the financial architecture. For liquidity takers, by and large, some risk is tolerable. They don't need to produce panic and runs unless, of course, initial outflow in moment where there is large demand escalate. So there is a moment in any liquidity run, which you don't have in a safety run, where you can start essentially try to use the fact that there is a different sensitivity to price, and that's where you can control by random measure that are forward by the SEC and ESMA on money market funds, which can be applied to also uninsured claim inside the banking sector. So I want to also relate this to another very important contribution to banking. Katja Rajanstein had a very important way to describe why banks are a natural supplier of liquidity in a crisis, because in a normal crisis, people have a so-called flight to safety, but it's really they put the money in the bank, and therefore the bank can naturally provide liquidity to the rest of the system. When you have a safety run, it's because people are running on the banks. That was 2008. That's not like 2020. And that's when the system is really undermined, because that is where the safety core is undermined. And that's where there is not much discussion to be had. So again, how can you by having a very strict ex-ante mandate, minimize risk? Well, first, you make sure that you don't have safety seekers in the wrong place. You make it very clear where the safety is and where it is not. Of course, you provide all the necessary liquidity against regulated entity, against safe collateral. All of that is the normal part. But you have to be as ambiguous as possible in any construction of that you will need to endure exposed in run, because every kind of promise of liquidity put will enhance moral hazard. So I think there is an issue of confusion, and that puts the wrong people under less safe claim, and there is an issue of moral hazard, which is, of course, everything to all of us. There are various things that come out of this view. It's not very different to what extent central banks say they do or largely do, but it's, I think, a reframing that is useful. So let me make another point where it could be useful. Consider the appropriate scale of central banks' balance sheets. Very important topic. Annette was talking about that all year. So we had this huge expansion of central bank balance, and they seem out of kilter. They look so large relative to GDP. But is GDP the right scale? Well, no. The right scale is, in a sense, the demand for safe asset that is out there, that to some extent you're safeguarding. So the evidence that Annette has been putting forward is that demand for central bank reserve is scaled up by deposit volume. There is a demand for safe asset that needs to be backed. Now here, let me show you two graphs I find useful. And I think they are very first take, because I would like to do various adjustments to this, and perhaps we will come into a discussion. If you look at the central bank asset over wealth and GDP, you see that at some point the volume of central bank balance sheet explodes relative to GDP. But if you look at the scale of financial wealth, they don't. I mean, they're there to back up some structural demand for safety that was extremely high after the financial crisis. After all, that's the reason why we could endure so many years of QE without creating inflation, because people were willing to absorb safe assets to a higher rate. And that is what, traditional macro could not ever fully anticipate. Okay, here there are various questions. I hope I'm still have 2 minutes. Yes, okay. So, nothing is fully safe. On the other hand, I have a very clear definition. Default-free nominal claims, which of course is, the usual suspect. There are, however, certain things that are open-ended. So one of the functions certainly belongs to protecting a safe course, to protect liquidity of safe assets. So that's the question of the role of the central bank in managing public debt trading. That was fundamental from the beginning of central banking. It certainly is now. There's in the paper I discussed some of the proposals out there about an increasing role of the central bank on the funding and clearing of trade on government debt. There are also other questions that really come into play. So, there's a lot of discussion in central bank whether we should backstop money market fund. Well, to the extent that regulation allows some regulated entity to promise safety of principle on demand, well, it's hard to say that that is not part of a core function. If we don't want money market fund to be, backed by the central bank, then we shouldn't allow them to promise, a safe principle. Other issue, which are delicate and I'll discuss in the paper, is about uninsured corporate deposits. Here, I don't personally think that this is the type of component that requires safety. Corporate deposits, where corporate cash pool were historically invested in money market funds, that's the natural treatment for them. This is liquidity demand that, of course, presume immediate access to liquidity as needed, but they can take a bit of price risk. And so just as we impose charges on sudden outflows of money market fund investors, we can very well introduce the principle that large corporate deposits remain uninsured, and if they choose to run, well, they're going to incur a price. And if you incur a price, you discourage the run. And that is the point about how we should deal with run, not bail out all the time. All right, so conclusion. My case for core safety mandate, the idea is we have to focus on, and I'm not saying the central bank should not do other things. Ultimately, the central bank is a public entity and responds to what the government tells them to do and all that. Here is about creating a benchmark. A benchmark that seems legitimate on the basis of the public function the central bank has, its monopoly position, and the notion that it's there to provide basic safety for households and not for everybody, because that, of course, is impossible. I think maybe the very last, I think there is a lot to be said about constructive ambiguity to minimize moral hazard. I think that part of the most, well, a visible consequence for this principle, any excess lender last resort mandate needs to capture, distorts risk incentive, confuses safety investors. There are proposals out there to let people to intervene afterwards at a penalty rate with people that were with entities that were not fully regulated. That never works. I mean, public insurance is always underpriced. Entities go bust. I mean, it doesn't work ex post. So I think if someone wants safety, that's no problem. They just need to be regulated. Very good. So I think I'll stop here.
Thank you, Enrico. You did quite well. Almost. The challenge was to do everything in 20 minutes, but it's fine. So now the floor is for Arvind, and we are very curious to know his comments and what he's thinking about this topic.
Okay. Thank you very much for having me here. I hope you can all see my screen.
I want just to remind you that if people want to ask questions, please just post them in Q&A. Thank you very much.
Okay, great. Let me get started. Enrico, thanks for writing this and having me on to discuss this. And I feel like I've had these conversations about these issues with you over coffee and beer and wine for the last 15 years. So nice to read and talk about this. So just to summarize what Enrico has said, and I'll do it in 3 sentences, what Enrico did in 20 minutes. He asks what I think is a pretty important question, which is that we know central banks do multiple things in the world, but 2 core things that they do are they provide liquidity to markets. Think, say, of a repo facility or the discount window. They also, and not just central banks, but governments more broadly, provide backstops to guarantee the safety of both public as well as private claims. Those, you can almost think of them, they're conceptually 2 different things that central banks are doing. And what Enrico is asking this question is, should we layer them in some way? How do we prioritize one type of action versus the other? And his thesis, which he outlined, is that safety demand, the demand for safe assets is price insensitive. Inelastic demand for safe assets, and it's only satisfied by some set of assets which are truly safe. There's a very large discontinuity that happens when you go from a truly safe asset to a less safe asset. Whereas liquidity demand is more price elastic and can be met potentially with different assets. And so he says, suppose that is true, then his proposal is the central bank should layer how it thinks about safety and liquidity, and it should work hard to maintain a core of safe assets. And if there's any costs of an action of providing more safety or more liquidity, prioritize and do more safety and maybe less liquidity provision. Okay, that's basically what he's saying. I want to basically do a few things. I'm just going to raise some questions. Okay, it's an interesting idea. I want to think it through. I want to raise some questions. I'm going to start with the questions through the lens of data, and then I just want to say a little bit about theory. Okay? So at heart, his thesis is about demands from the economy as a whole for safe assets as well as liquid assets. So he's telling us that the demand for safety is very price inelastic versus the demand for liquidity is more price elastic. So if you want to verify that in some way in the world, what you want is an experiment like reduce exogenously the supply of safe assets by $1. What happens to the spread between a non-safe and a safe asset? What happens to like a safety premium? That's one object you'd like to look at. And then the other experiment you'd like to do is reduce the supply that's supposed to be liquid assets, not safe assets. Reduce the supply of liquid assets by $1. What happens to the spread between, error here, illiquid asset and a liquid asset, which is a liquidity premium. Okay. So you'd like to look at 2 separate asset price spreads, a safety premium and a liquidity premium. You'd like to change the supply of both a liquid asset as well as safe asset by $1 and ask how much each of them move. And I think what Enrico would like to ground his proposal on is that the safety premium effect is much larger than the liquidity premium effect. Okay, so I'm just going to start by showing you some data because this is from work with Annette Wissing-Jorgensen, and I see actually Annette is on as a participant today. So if anything I say is wrong, she can correct me. This is a table from one of our papers. And the first row, if you look to the right in this table, is changes in low frequency changes in the supply of total treasuries scaled by GDP. That's the explanatory variable. And the first column is the AAA treasury spread, AAA corporate bonds versus treasuries. When you look at the spread between AAAs and treasuries, AAAs are both less safe as well as less liquid than treasuries. So there's a spread effect there. This is long-term AAAs and long-term treasuries. There's an effect, and this is the effect that Annette and I discovered in our paper a decade ago. If you look to the right, the two columns on the right, I think, are much more close to what Enrico's after. Now we're looking at short-term stuff, which is, I think, the core of what he's interested in. The first column is the spread between P2 rated commercial paper and P1 rated commercial paper. So P2 rated commercial paper is less safe than P1 rated commercial paper. P1 rated commercial paper is effectively like AAA corporate debt, short-term corporate debt. So that's a spread between a less safe and a safe asset. Neither P2 nor P1 rated commercial paper is liquid. So this looks like a safety premium. Okay. And notice I'm particularly, we're constructing the spread not relative to T-bills, which would be another thing you could construct it to. The reason not constructed with relative to T-bills is because then you'd be having a spread that reflects both a difference in safety as well as a difference in liquidity. So this is a kind of this is a closer thing to the ideal experiment that Enrico wants. So you see elasticity there minus 0.88. Okay, so reduce by 1% total supply, you change the spread by 0.88. The rightmost column is the spread between P2 rated commercial paper and bank deposit rates. Okay, now we have a spread that is definitely has some safety differences, but has a big liquidity difference. Deposits are much more liquid than P2 rated commercial paper. You see a much a bigger effect there. So if I just look at these two things, it doesn't jump out at me that the demand for safety at a low frequency, which is what is measured here, is less price elastic than the demand for liquidity. In fact, this thing actually suggested it looks the opposite way. The experiment is not perfect because P2 versus deposits is both less safe as well as less liquid. So the comparison is not strict, but you can just do subtraction here and realize that you need something quite big to overturn this. Okay, so that's one issue that one has to deal with. Now, I think, and in the paper, Enrico talks about this, maybe that low frequency evidence is not the thing to hang your hat on. Maybe the relevant question is what happens during a financial crisis. Maybe, and quite plausibly during a financial crisis, all these demand curves turn much more steep. And so that quantity changes could have dramatic effects. And we do know that, for example, spreads between safe and less safe, P2 T-bills, P2 P1 really blow up in crises. Investors seem to discriminate much more between safe and less safe assets. Now, it's not a perfect experiment because we also know in a crisis, there's risk differences here that are also being exacerbated. So empirically, you can't just look at that spread and conclude anything, but that's the type of thing that I think Enrico is more hanging his hat on. So let's suppose that's true. And the key argument of the paper, and this is another way, another way empirically to go after this paper, is that there's not enough safe assets in the state of the world financial crisis, right? That's why ex-ante, you'd like to maintain a stock of safe assets to maintain that core. That's, again, his argument. So again, the empirical counterpart of this would be if the government was to expand the supply of safe assets in a crisis. Now, what I showed you before is on average during normal times, but suppose you just add the dollar in the crisis, you should see things get much better, right? And things getting much better would be looking at those spreads I just showed you and showing me that safe asset premiums, safety premia, really respond much more dramatically, for example, than liquidity premium. I don't have such an experiment. The closest thing I can think of to experiments like that are we have things like the dollar swap lines, which were expanded by central banks during financial crises, that probably have something to say about this. There's some experiments on guarantees that happen during crises that definitely have an effect. I haven't seen any systematic evidence on this. That would be the type of thing that one would want to look at. Okay, so that's spreads. Now, spreads are in a way a shorthand for something you're really interested in. The welfare question is probably much more closely measured by quantities rather than prices. Prices are indirect; they're measuring some marginal valuations, and then you need to do some transformation. So the things getting better. The other type of thing you'd like to see is, to take the dollar swap lines. If you were to expand some supply of that in a crisis, is there some quantitative sense, bank lending, investment, something like that, expands? That's again the type of thing you'd like to do, and you'd like to see that it happens more with expanding safe assets than liquid assets. Okay, so those are empirical things that I feel like one needs in order to ground the thesis that Enrico is presenting. Let me talk about one more point, which I think is just a complication that floats around with this stuff. If you think about the standard prescription we have, Badgett, Diamond, Dybvig, on how the central bank should act in a crisis, it's the central bank commits to making bank assets liquid, right? Lend reserves against collateral. Set a high haircut, but lend reserves against collateral. That's liquidity against an illiquid asset. And the analysis, say in Diamond Dybvig, is as a result, the bank doesn't have to liquidate the illiquid asset, and therefore the depositors don't have to be worried about the safety of their deposits. That sounds like by acting to maintain liquidity, what you're actually on the side doing is you're delivering safety. So I just want to back up and say that it's hard to disentangle these two actions. I can act to maintain liquidity, and then an effect of that might be, and maybe the most important effect of that might be, to maintain safety. So then if you step back, is it clear how one should think about these two actions and view them and delineate them as clearly as Enrico has? So I'm sort of unsure where I stand with this. I mean, I don't have any more data or any more evidence than what I've shown you, but my instinct is actually that what's important is to maintain both liquidity and safety of a core set of assets. And that, and Enrico showed you this triangle at the beginning, and to me, it's liquidity and safety that sit in the bottom. That's certainly the way I've thought about treasuries in both the domestic context as well as the international monetary system. I have a harder time pulling those two things together. And so then I'll just leave Enrico with a question, which sure seems like the logical conclusion of his proposal. Okay, thank you.
Thank you very much for your thoughtful and suggestion and question. I don't know, Enrico, do you want already to start to answer, or are we going to collect a question from the
give me
audience?
1 minute, I promise.
Yeah, okay, fine.
So thanks a lot, Arvind. I knew you were going to challenge me on the evidence and also the thoughtful. So many comments. So first of all, I agree with you that the price is less important than the quantity. When we are concerned about stability, it's all about runs. That's quantity by and large. So I think what you put forward on the quantity side is most relevant. I never say that you need to increase the supply of safe assets in runs. In fact, I'm convinced the central bank should do exactly using the safe component of private assets to supply liquidity, the safe component. That's what is indeed staying within the core. You're lending against good collateral regulated entity, and you lend all you need, because indeed lending liquidity is what will stop many liquidity runs. On the issue of quantity, I want to stress this. Okay, this is a question of perception. I remember at MIT, we used to talk about making model based on introspection. And so to me, safety is more primary than liquidity. And in that sense, I think there is the layering. I mean, the reason we stopped runs in 2008 when the money market funds were basically told, okay, you're fine. And not when huge, a lot of liquidity went into shadow banks, but it was really the one layer that just couldn't afford to take any risk because those people didn't want it at all. That made a big difference. Obviously, not about narrow banking. That's silly. It's very much about the function of using proper safe collateral is the base for lending, lender last resort. There are many more things to say, and I'll be thinking about it. And now let's leave it to everybody. Thanks.
Very good. Thank you very much. So let's start with the first question. So the first point that it has been asked is, what are the features that the penalty rate of a lendable last resort facility should have? Should this rate be defined on a generic way and known by all market ex ante or case by case? So what is your view regarding how to you plan this?
So, well, let me say briefly. So I presume this is about the ex-post lender last resort when you intervene, obviously outside the safe core, and you stretch liquidity for a reason that are evident at the moment. And then there are people who believe, look, we could just announce this is what we're going to do. We're going to use penalty rates, and then everybody who went too far, will be penalized by the very high charge that we impose. I think there are many issues with that. There are proponents out there doing that. I think Paul Tucker has a notion of that. There are many issues with imposing penalties. First of all, it's exposed. The risk is already out. There is a need to have a lot of disclosure if you are starting to do purchase, private asset, private claims, or refinancing beyond the safe. And once you start creating a lot of disclosure in order to impose this pricing in a legitimate form, you're making things more difficult, according to people like Charles Goodhart. It's very difficult to have a lot of disclosure in a run. And so it's very difficult to do the exposed penalty. Although in principle, if you do anything outside the core, is to do it on a penalty rate. But it's not an optimal solution. So I'm not sure I answered the question, but at least I explained what I see the problem with that.
Okay, so then I know, Annette, since you are here, maybe you can ask directly your question if you turn on your camera. Yes.
So I guess if you think back to what central banks are doing, historically they print money, the role of liquidity is very much at the heart of managing payment systems. So similarly, you could think of reserves as a kind of money for banks that facilitate settlement and so forth. So I would say that central banks should perhaps start with liquidity, and then they should just try to not mess up the supply of safety, in the sense that basically what I argued in my center paper for this summer was that to the extent that the central bank can supply liquidity in the form of reserves without at the same time buying treasuries or German bonds, then it's doing better from an overall perspective of supplying convenient assets, be that liquid or safe ones. And so if, for example, it's possible, like the ECB has historically done, to supply reserves by lending to banks as opposed to buying government bonds, that would increase, that sort of would put the central bank at an advantage in terms of supplying liquidity, because they could do that without at the same time buying, taking away safety. And so in that sense, I would say start with, sort of maximize your liquidity supply, ideally without at the same time taking away something safe. And in that sense, I think we should pool safety and liquidity into sort of a convenient, we should try to supply as much convenience to the private sector as possible, be that from liquid assets or from safe ones. But I would say that the key lessons that I have learned from thinking about this for a while is that the optimal size of the central bank's balance sheet is much bigger if you can do like the ECB historically did, and you can supply liquidity without buying safe assets. Whereas if you're a central bank like the Fed that has announced that it's going to supply reserves by holding treasuries predominantly in the longer run, then the optimal balance sheet size is much smaller.
Enrico, do you want to comment on this?
I agree. It makes a lot of sense. I mean, I don't want to create the impression that I don't think the central bank should operate liquidity. That's what the central bank has. My question is, first of all, about the ex-ante posture, as opposed to what you do exposed. Exposed, you will provide liquidity. The ideal form, and the one that you should do all the time with our question, is against the safe part of private illiquid asset. That's still within the safe core. That's the standard lending against collateral that you're talking about. I completely agree. The challenge is when you go beyond that, when you're starting to stretch the provision of liquidity against more dubious assets, or really really treating at par value, or especially when they're not in the safe core. At that point, it becomes really highly creative, and you do all kinds of things that you need to do in a mess. But the question is, can we limit the potential mess? And the other thing that I'm really extremely keen is to make sure that people that look for safe store of value don't end up in the wrong assets. And I think this is the confusion that we are really facing, that people have been migrating to some extent in new places, and we shouldn't be sending the message that all these other shadow constructions are equivalently in terms of safety. Anyway, but I very much admire your work on the scale of the central bank balance sheet, and I think what you say about how to intervene without removing safe assets is something worth to think about.
Good. So, we're still going to having questions that try to understand really what is your proposal, Enrico, because there is this question: how could central bank target core safety as opposed to liquidity? So how can you really disentangle the two? Should they change their mandate? Should they increase scrutiny on asset and riskiness, or make sure that the banking system keeps properly separated and defines safety and liquidity assets? Should the issue be solved, mitigated by central banks looking at assets or at banks' behavior? So, it is still on this distinction between safe asset and liquidity. How are you really going to handle this?
Oh, okay. That's so I'm starting with the benchmark. And then the benchmark has to be useful to answer this question, obviously. First of all, my statement, once again, is about the ex-ante mandate. There's a lot of pressure nowadays to alter the ex-ante mandate of central bank. And that, I want to know what is the fair public task for the central bank to do before you push political or other motives into their balance sheet. So to me, maintaining support of credit into the economy and economic stability is about first securing the safety. And if you start to have policy that in the end create ambiguity about where the safety lies, you're creating potential instability down the line. Of course, liquidity is what the central bank provides. It's not. It's about how it does and what it commits to do. I think where the mandate can cut something. So what is the central bank core benchmark of responsibility? If the government declares that something issued by a regulated entity is allowed to promise safety principle, it becomes a public responsibility. And I mean, that is where the safe core stops. And then you become very clear on the fact you don't want to encourage anyone else to say the liquidity will be forthcoming beyond the type of refinancing that you can go on market terms on the safe for against good collateral. So I guess the question I put is maybe larger than what I was able to answer. I think that's a big. There is a lot to be done here, but I think the point I want to make again is that it is the ex-ante policy that has to define where the safe asset, quasi assets are, the supported and not supported. This is what the central bank has to make very clear to everybody in terms of its benchmark task.
Okay. So, Arvind, clearly, if you want to intervene, please feel free. Otherwise, I will go on with the question. Actually, at the end, I want also to ask some question, but I will take first the one on the list. So there is another question. So how do you think of the separation of duties and of the correlation between fiscal policy and monetary policy in ensuring the core supply of safe assets over the cycle? So pretty much I can also add to this, if you need safe assets, it's enough that from the fiscal point of view, you just issue them. The Finanzagentur will issue a lot of booms. That's it. Why do we need when there is demand? Can this done also?
Well, I think this is a very important larger question because, you know, think about what was happening during the credit boom. There was a massive demand for safe asset, very strong, and not liquid because, you know, mortgage-backed security were never traded, they were not liquid. So, and the government wasn't supplying as much as demand was producing. And part of the issue was that markets were booming, so wealth was booming. Demand for safe asset rise with that. And the private sector supplied, but they weren't safe asset, they were quasi safe asset. And in the end, how we rescue the system? Well, they became public asset. You know, we insure things, a lot of public debt was issued, and then you had the rebalancing of what was demand for safety and supply of public safety, and, you know, got rid of a lot of fake safety that had been built on the way. Now, so the issue of tracking demand for safety, I mean, I think it's remarkable how in these 15 years we've seen since the crisis, we see such a huge amount of money creation being absorbed by the public, reflecting essentially a very strong demand for safety. It's not because GDP went up a lot and our transaction need went up a lot. No, I think we just need more. The desire need for safety in these circumstances, and given the volume of financial and nominal wealth we had, just scaled up, and we absorbed a lot of public debt. So these things are integrated, and I don't think I've thought enough about being able to answer that question, but I think these issues are indeed closely related.
Okay, so the other question, is one implication that central banks should refrain to act as lender of last resort of non-bank financial institutions?
Yes.
So you are convinced of this. Arvind, are you convinced of this?
I'm talking about the ex-ante statement, right? So that's what yes.
What is your view, Arvind?
Yeah, I just want to bring up one other thing. Enrico, this comes up in your paper, and you didn't talk about it that much in your presentation. You talked a little bit about it, but it actually seems quite important, and it relates to this question as well. You know, there's investors ex-ante who buy an asset that's safe, say T-bills, and they buy another asset, say commercial paper, that ex-ante they view as, and it truly is safe, right? In 2005, you bought 3-month commercial paper, you were basically sure it was safe. And then you just kept rolling it over. And what seems to happen in the world is that a private safe asset, maybe even a public safe asset in the case of Europe, can somehow transit very quickly from safe to unsafe. And that shift creates a mess, right? And that's the sense in which core is important, and delineating where you draw the line is particularly important.
I agree. So the point, I so agree, and I think this is really, there's a lot of work to be done here, if it's useful at all, the concept. But the notion is you don't want to create a system in which things are presumed to be safe, and because they're presumed to be safe, there will be a lot of production of them because they are even more profitable to produce. Think of AAA mortgage-backed security. You know, they'll be manufactured because it's believed to be safe, so it's very valuable to issue. And you don't want that to run out of control again. And where in the end, people expect you to intervene, and because you start to draw all the wrong people in there. So it's a very, I think by and large, this is exactly the challenge. If you want to monitor, I think it's a dynamic process. I guess that's what you're saying. There will be transition in the evolution of the financial architecture such that some assets may look more or less safe. To the extent that commercial paper is held by money market funds that accept the kind of regulation that includes charges or other exit costs upon outflows, I think there should be backstop in liquidity terms, of course. So yeah, that's as far as I can go with that. Okay,
so we're almost at the end. So now I'm just using my, let's say, the opportunity for me to ask one question. You are talking also about the uninsured corporate deposits, and you are, in a sense, proposing to use the same regulation for money market funds. So, penalize when there is a sort of run. But, ex-ante, you say this should prevent the run. But what we know, if we are looking to the cases, the empirical evidence, is that, these uninsured corporate deposits, actually, they were used also to pay the wages of people. And at the end, we know that there was a bailout. So, and on the other side, this type of uninsured corporate deposits, when in some sense back up with safe assets, or at least what we call safe assets, that are treasury. The only problem is that the value of this treasury has been reduced. So if I'm using, all your categorization, safe assets are core assets, and uninsured corporate deposit can, be treated as money market funds, but then it is not clear why you are using deposits. You can go to money market funds directly, and all the corporates should move there. So if there is a difference between the two, we need to try to figure out why, and then maybe think that also corporate may require for a certain level, maybe not to 100%, but make clear that these deposits are safe and they can be sure that they are able to pay their workers, and maybe the rest can go straight away to money market funds. Otherwise, I really don't see your story, how it's working, if we are really looking from the practical perspective.
Okay, so that's a very fair challenge. I think when you think of basic safety that you want to provide to the broad population, and you bring up the issue of wage payment, I mean, 1 month wage is the amount that we are talking. That is a small fraction of the amount that Silicon Valley Bank customers had. These were not their wage payment. These were their cash balances. Historically, corporate cash pool are in money market fund because they can definitely deal with a bit of volatility for the yield they get, which is a big difference. So I think that you can separate the two. You could define an operational deposit in a less generous way than it was done under Basel III.
And you pay for this ex-ante, I'm not saying that you shouldn't pay. I
mean, that's legitimate, and I don't have an issue with that. I think, however, to just unconditionally say that we should backstop bailout, corporate cash in any amount which is kept, it doesn't answer any real fundamental principle of public need. I think that you can give deposit insurance and price it for an amount that is legitimate and justifiable in terms of basic safety. Yes. Anything above that could be subject to pricing. I mean, they will still be able to withdraw and pay people. They just have to pay 3%. If SVB deposits have left 3% on the way out, the bank would have been recapitalized. So I'm not saying this should be activated often, but it's just when it really matters. I don't see why we should be at the mercy of, self-coordinating around uninsured deposits that are de facto able to force a bailout all the time. The distance between solvency and bankruptcy is just too narrow then. So I don't think it's a responsibility of the Fed to resolve this issue. I think it should be a business proposition and say this is not this kind of demand that deserves public safety assurance. That's my view, of course. But that would also resolve the issue of why do you need the central bank to intervene way beyond the safety core? To avoid the bank to fail. Yeah, well, but there are other solutions too. Liquidity, that kind of liquidity pricing can be contained by discouraging the escalation. Essentially, that's my argument.
Okay, very good. So we are out of time now, unless Arvind want to add something. I think that, I was learning a lot, and I want to thank, first of all, Enrico, that he was really, pushing and writing this document and pushing for this idea. Arvind, thank you very much. Your discussion was great. We are learning a lot. Also to Annette that just jumped in at the end, and it is great. And, I'm sure that there will be other web seminar on this topic. We are not at the end. So, but I wish to all of you a very nice evening. Bye-bye.
Thank you very much.
Bye-bye.
Thank you.